The accounting records of Viviana Shipping show the following assets and liabilities as of December 31st, 2008 and 2009, and you see the information appearing in the table on the screen. Late in December 2009, the business purchased a small office building and land for $199,002. It paid $100,000 cash toward the purchase, and a $99,002 note payable was signed for the balance. Miss Viviana had to invest $37,000 cash in the business to enable it to pay the $100,000 cash. The owner withdraws $2,600 cash per month for personal use. Requirement 1 asks us to prepare balance sheets for the business as of December 31st, 2008 and 2009, and they give us a hint. Report only that total equity on the balance sheet, and remember that total equity equals the difference between assets and liabilities. Okay, the first thing we need to do is identify which accounts are the assets and which accounts are the liabilities. And now you see that I've highlighted the asset accounts, and assets represents items that have economic value or future economic value, and these are highlighted in yellow. Liabilities represent obligations, and those are highlighted in green. Okay, now I've provided what the balance sheets would look like as of December 31st, 2008 and 2009. Note that I don't have the proper title with the company's heading in the word balance sheet for 2009, and I've done that just to save some room on the screen so that we could get this on and you could see it. But what we do is we drop in the assets that we calculated previously, or not calculated, but determined which accounts were assets, and we come up with a total asset number. Then we drop in the liabilities, and remember that the assets less the liabilities would equal total equity. So for 2008, the $245,500 less the $66,285 of accounts payable gets us $179,215 of total equity. And then of course when we add the $179,215 of total equity to the accounts payable, we come up with total liabilities and equity of $245,500, which equals the total assets as well, and we know we're in balance. Now that was all for December 31st, 2008. In 2009, we repeat the process using the information provided for the assets and liability accounts that we had as of December 31st, 2009. And here, looking at the bottom area of the highlighted area on the screen, you see that total assets were equal to $416,147, and this time we had two liability accounts, accounts payable and notes payable. The total of those equaled $131,877. So therefore we compute equity by subtracting the total assets of $416,147, or I'm sorry, subtracting total liabilities of $131,877 from total assets of $416,147. And that's how we derive the $284,270. And again, when we add the equity as of December 31st, 2009 to the liabilities at that same date, we come up with $416,147 of total liabilities and equity, and of course that matches the total assets, and we're in balance. Requirement 2 asks us to compare equity amounts from the balance sheet and use the additional information presented in this problem to prepare a calculation showing how much net income was earned by the business during 2009. Let's take a look at how we would answer requirement 2. From the previous slide, we determined that equity at December 31st, 2008 was $179,215. A year later, on December 31st, 2009, we determined that equity then equaled $284,270, and that means that we can determine that there was an increase in equity during, and it says 2008, but that should read 2009, for $105,055. Now, the additional information also told us that the owner had made an investment of $37,000. An owner's investment is not part of net income. It's considered an additional investment of capital, but it is not the result of revenues less expenses, which is how we calculate net income. So we know that there was an increase of $105,055, and we need to back out the $37,000 of the owner's investments, and then we need to add in the owner's withdrawals. Withdrawals are also not considered to be an expense of the business. They're considered to be a distribution of the assets of the business. Expenses are the ordinary and necessary outflows and other uses of assets that a business undertakes in the hopes of generating revenue, and then obviously in the hopes of generating net income. So, starting with the $105,055 of an increase, we back off the owner's investments and add in the withdrawals, and that's how we can calculate what net income was for 2009. And on this problem, it comes out to be $99,255. Requirement 3 asks us to compute the 2009 year-end debt ratio for the business. Okay, and here's the December 31st, 2009 balance sheet that we previously calculated, and down at the bottom you see how we calculate the debt ratio. We take total debt, which is $131,877, and you can follow the blue line to see where I'm getting it from on the balance sheet, and then we divide it by total assets or total liabilities and equities, since the dollar amounts are always the same, and that comes out to be $416,147. So when we divide the total debt of $131,877 by the total liabilities and equity or the total assets of $416,147, we come up with a debt ratio equal to 31.69%.